Good morning to one and all. Today we are going to discuss about financial derivatives. Myself, Dr. V.G. Murgan, working as an assistant professor in Department of Management Studies, Madanapalle Institute of Technology and Science. I would like to thank our correspondent, principal, and head of the department for giving me this wonderful opportunity. And these are the slides that we are going to present. Financial derivatives, the overview of a presentation. These are the few things that we are going to cover within this session time. Introduction, derivative meaning, classification of derivatives. Basically, there were four classifications: forward contract, future contract, options, option strategies, which is included in an option contracts, and swap contracts. Majorly, we are going to cover about the four contracts: forward contract and future contracts, option contracts, and swaps contracts. And first, we'll move on to the derivation introduction slide. Introduction related to financial derivatives. Basically, an investor who make an investment in capital market is something purely risk oriented and uncertainty. Being a kind of an investor, making an investment in capital market, there might be a chances to multiply their investment to some extent, double the time or triple the time, even 5 times or 10 times. At the same time, parallelly, there might be a chances to come down their investment even to zero. So it's purely a risk oriented and uncertainty. So in this scenario, an investor who is not ready to take a risk, then it is not advisable to make an investment in capital market. For such a scenario, for such kind of an investors can able to make an investment in derivatives market. Basically, derivatives is a kind of an securities, is a kind of an instrument whose value is not an independent one. A derivatives is one which is purely on the dependent one. Basically, derivatives is something we call them as an underlying asset. That underlying asset might be anything, maybe a currency, maybe a gold, maybe something stock prices or indexes, or might be anyone's, etc. etc. See, basically, if you say something about an derivatives, and probably derivatives is a kind of security, what which we discussed about previously, is determined by an underlying asset. And derivatives can be such underlying asset can be anything, maybe a commodities, maybe a bond, maybe a currencies, might be anything. For example, if you want to say about an derivatives, take an example about an buttermilk price. The buttermilk price is purely dependent on the price of the milk, because if the price of the milk rises, then the buttermilk price also started to rise. So here the point is something about the price of an buttermilk is purely dependent on the price of the milk. Similarly, derivatives is one where the price, where the market is purely dependent on the underlying asset. Such underlying asset we have been discussed previously. And basically, we are going to discuss about types of an derivatives market classifications. Basically, classifications of four categories: forward contract, future contracts, options contracts, and swaps contract. And if you start saying about an forward contract is an agreement between two parties to buy an asset or sell an asset at a specified price at a specified date. For example, if you want to make it very clear, being a kind of an Indian textile company, for example, making an importing of goods from an US company, a textile commodity. So, being an Indian company wants to make a payment of $1 million. Being an Indian company, right now they have been short of funds. Probably they are going for the 3 months credit basis or some extent to X scenario. In that scenario, a company might able to go for a credit basis of in 3 months. Now, Indian company, it is clearly known that within these 3 months, the price of a dollar is going to shoot up to, as of now, take an example, now it is around 83 rupees. As of now, there might be a go to chances to 90 rupees or 95 rupees. If now a company, Indian company, makes a payment for $1 million, they will pay around 82 million rupees. But after 3 months, if they want to pay, if it is shoot up to 95 rupees, then they has to pay a amount of 95 rupees to the particular scenario. For that point of time, now a company can able to make an agreement with a third party, that might be any bank or might be some other financial institution. In that scenario, a company can able to make an agreement for the point of an getting an $1 million for the cost of an 85 rupees. Now it's a cost around 82 rupees or 83 rupees. Additional by paying an 2 rupees, they are getting an $1 million from XYZ bank. Then they make a payment to the US based company. Then at the end of third month, a company, Indian textile company, wants to make a payment of an 85 rupees to the XYZ bank to some extent. If suppose the dollar price shoot up to 90 rupees or 95 rupees, a company, being an Indian textile company, might be safeguarded to of paying a 95 rupees, 95 million rupees, in the point of view something called about an 82 rupees. That is an 82 per dollar price to some extent. This is something about in where safeguarding of your particular scenario where the risk can be covered. This risk coverage is something we used to call them as an risk coverage. We used to call them as an something about an hedging. And then we move on to the futures market. Similarly, about an futures market is also similar to the forward contract. It is also an agreement between two parties to buy an asset or to sell an asset at a specified price at a specified date, which is something called about in here. A forward contract is something about a customized contract, and future contract is something called about a standardized contract, where the future contract is traded under the stock exchanges, and forward contract is one which is something called about an over the counter OTCE point of time which used to be in. Here, the only the difference amount will be transferred in the future contract, and the probably something about in forward contract, the entire transaction amount might be transferred to some extent. So apart from this, both contracts might be similar to some extent, but generally people used to prefer to make a trading in a futures contract because it is a standardized one which will be traded in the stock exchanges to the particular scenario. Whereas future contract is also an agreement between two parties to buy an asset or sell an asset at a specified price at a specified date. That is the most important point need to be focused about in the particular scenario. The next one is something about in the third classification. What we are going to cover is something about an options contract. It's a very, very important contract where most of the trading undergoing with this kind of an contracts. Options contract, it is an option which is something called about an here. It is a kind of an agreement between two parties, either to buy an asset or sell an asset at a specified price at a specified date or might be on or before the specified date. If you want to discuss about this options contract, we have to need to know about two style of an options contract. One is in European style, another one is something called about an American style options contract. And the European style options contract is one where the agreement or the trading might be done at a specified price at a specified date. Whereas American style option is one where it is an agreement between two parties either to buy an asset or sell an asset at a specified price on or before specified date. So there might be a chances for the investor either to make a trading, either to execute a contract, or either to cancel a contract at a specified date or before the specified date. For example, 90 days contract, if an investor is an option holder entering into the contract, then he may execute the contract or cancel the contract at the 98th day or 80th day or 5th day or even 6th day, because here the option holder has a right either to execute or cancel on or specified date. On or specified date indicates that till the time where the investor have an options to make a kind of an execution or at the same time to make a option of cancelling the contract. Here basically if you discuss about an options contract, we have two types of an options contract. One is something called about an call option, another one is something about an put option. Call option is an agreement, is a right, not an obligation, is a right to buy an asset to which is at a specified price on or specified date. At a specified price on or a specified date is most important point here, because for example, if you take an example about an Infosys Limited, which is listed in NSE, the share price is something about 10,000, something called about 700. For an example, take an example as 1,700 Infosys share price. If you believe that in a long run process, a company share price is going to shoot up to something about a nearly around 2000 or 2200, merely something about it is going to rise or increase more than 1700 rupees. In that scenario, it is advisable for the investor to make a choice of buying your call option, because if you buy a call option, you are having the right, not an obligation. You are having the right to buy an asset at a specified price on or before the specified date. If that is a scenario, if the share price is shoot up to even 2000 or 2300 or 2500, which you made an agreement for the 1800 or 1750 with a premium of an additional charges. For example, you made an agreement for 1750. As of now, is 1700 is a share price. Even it is shoot up to 2000 or 2500, the option writer no obligation, they has to sell it to you for the 1750 which you made an agreement, because you are paying a premium for getting such kind of an right. So option contract which is related to the call option, it is a right, not an obligation to buy an asset at a specified price on or before the specified date. So even if it is shoot up to 2500, you are going to get a share price at the price of 1750 rupees. So this is most important point need to be noted here. If suppose, here the point is something about, and if the share prices shoot up, you will be benefited. Being an investor will be benefited. If suppose, if the share price started to decline due to some unexpected changes, if it is declined to 1500 or 1400 rupees, if you make in a contract with a particular option seller, that is an option writer, you made an agreement for 1750, then you have to get it for 1750, but actually it is available in the market for 1450. In that scenario, if you execute the contract, you might be put into trouble. You might be face a loss of 200 or 250 rupees. In that scenario, you are having a right either to execute the contract or either to cancel the contract. So this makes an indication that it is a right, not an obligation to buy an asset at a specified price on or before specified date, which I am quoting about an American style option. So which makes something about a 90 days contract, either first day, seventh day, might be 10th day, might be 80th day, till 90th day, you have an option to execute the contract or to cancel the contract. That is the most important point need to be understood here. So option contract, which is a call option, you are getting a right to buy. If you buy the call option, you are getting the right to buy the shares or might be asset from option writer at a specified price which made an agreement on or before the specified date. That is the most important point need to be noted here. The another one is something called about an put option. Put option is one which is something called about an, it is also similar to the call option. You are getting in right to sell an asset at a specified price on or before the specified date. I'm discussing about an American style option. So here the point is something called about, and you might be able to, for example, due to COVID or something about a couple of weeks back, the bank nifty, the prices started to decline, which is made a huge shock. Something in that scenario, some XYZ company, which is something about, and the share prices started to decline. So in that scenario, now take an example, the share price is around 100 rupees. If suppose in long run, in future, a couple of months, you may think that the share prices too started to decline. In that scenario, you might able to go into the put option contract. So put option contract is nothing about an, it is a right to sell an asset at a specified price on or before the specified date. Now you make an agreement for 100 rupees that you are ready to sell the shares for 100 rupees, for example. An option writer is ready to buy it for the 100 rupees from you. Being an option holder, you are being as an option holder. In that scenario, now what happens here, for this you have to make a premium charge. You have to pay a premium charges, something about in 2% or something 0.1%, something premium charges you have to pay. Take an example, about 50 rupees for making a premium charges or 15 rupees for making a premium charges. In that scenario, what you might be able to do, if the share prices even decline to 70 rupees, 60 rupees or 50 rupees, it doesn't going to make any drawback or trouble to you, because you made an agreement with an option writer. that you are going to sell it to the option writer, and option writer also agreed to buy with you for 100 rupees. If it is declined to 40 rupees or 30 rupees, you might sell the share to the option writer for 100 rupees. You will be benefited. So by executing the contract, you will be benefited. The huge difference, if it is in share price is in 30 in the market at the end of 60th day, and you made an agreement with an option writer for 100 rupees, then you might be able to get a benefit of in 70 rupees, that you are not being put into trouble for the particular scenario. So this is one best way where you can able to hedge, you can able to cover your shares or protect your securities to some extent. But at the same time, at any cost of time, when the share price is started to shoot up without couldn't be able to predict the particular scenario. In that scenario, even if the share prices started to 140, 180, even 200, for example, now what happens? Being a kind of an option holder, you have bought a kind of an put option. You are having the right to execute the contract, at the same time to sell the contract. For getting this right, you are paying premium charges to the option writer. If it is increased to 200 rupees, you have made an agreement for 100 rupees. In that scenario, what you might be able to do, if you execute the contract, what will happen? The mark, if you sell it in the market, the price of the share will be on 200. If you made an agreement with an option writer, if you sell it for something about 100 rupees, you will be put into trouble where the option writer will be benefited. In that scenario, you have an option, you have a chance either to execute or either to cancel the contract. So this make an indication that if the share prices increases, you will cancel the contract. If the share prices declines, you will execute the contract for the put option scenario. Even if you move on to something called about an call option point of view, if the share prices increases, you will buy the call option. If the share prices, in the sense the Sensex increases, if you see this option strategy is a simple formula where you can able to understand. So bullish and bearish trend. So when there is a bullish trend in the sense where the share prices, the Sensex started to shoot up. So if that is a scenario when the share price increases, rises, it is advisable to the investor to buy the call option, because even if it shoot up to maximum level, there is an option writer who accepted your contract, agreed to sell it to you for the particular price. So if it is an increases, it doesn't make an impact to you if you buy the call option. At the same time, if the share prices started to decline, in that scenario, it is not advisable to go for buying the call option. So in the bearish trend, it is advisable to go for buying the put option. So both the option contract, either call option or put option, you have to buy first. For buying the shares, if you buy the option, that is called call option. For selling the shares, if you buy, that is called about an put option. Here the point is, in a bullish trend, you have to buy the call option. In a bearish trend, you have to buy the put option. The reason is, if the share price increases 1700, you made an agreement with an option writer for Infosys. It may rises to 2500 or 2200. Even it reaches 2500, option writer who made an agreement to buy it to you for the 1700. So even if it is available in the market for 2500, you are going to get it for the 1700 rupees. The difference amount 800 rupees will be benefited if you buy a call option in the bullish trend. So that is one more important point need to be highlighted here. And what about here the bearish trend? If the share prices decline, in that scenario, if you buy the put option, it is advisable to buy the put option. If you buy the put option, what happens here? Even the share prices declines to 30 rupees or 40 rupees. If you have made an agreement for 100 rupees, the option writer will accept your contract and will buy from you for the 100 rupees if you buy the put option. Then you might be able to sell these shares to the something called about an option writer, where again 30 rupees if it is available in the market, and if you are selling it for 100 rupees because you made an agreement with the option writer. So that makes you a kind of an liberty, flexibility, and protecting your risk in the particular scenario. So where the other angle is something called about an sell. So the buy angle is something we used to say about an option holder, whereas sell is something called about an option writer. Here, if you are being an option writer, then it is advisable, it is best to go for in a bullish trend to sell your put option, because if it is a bullish trend at any cost of time, option holder going to cancel the contract. Because if you sell the put option, what happens? To some extent, even if they buy the put option, when the share price is increasing, which I told you about 100 rupees the share price, then automatically you are going to sell the put option. In that scenario, even it is goes to 30 rupees, you will be lost. When it is an increasing trend, if the share price is 100, it may shoot up to 200 or 300. Then in that scenario, if you want to sell to you, being an option writer, if you want to sell it to you, you will get for the 100 rupees, you can sell it in the market for 300 rupees because it isn't increased. But at the same time, if they are an option holder, if they sell it in the market, they can benefit it by 200 rupees by selling the share at 300 rupees. In that scenario, option holder will cancel the contract. Being an option writer, he may think that he, with an 100% intention of cancellation of the contract, premium charges, that will be a benefit to the option writer. So the concept of a sell scenario, option writer is purely risk oriented. So there might be huge losses to the option writer, whereas option holder, the risk can be completely to some extent will be protected. The huge loss could not be happened in the option holder perspective. So that is the point which we used to say an investor who expects a bull market should always buy a call option. An investor who expects a bear market should always buy a put option. So the seller receives the premium, but his risk is uncertainty and unlimited. So that is the foremost important point need to be understood here. So whereas in the forward contract and future contract, you don't have any other option either to cancel or something about it. You won't have any right, in the sense you won't have any right to do a particular scenario. Whereas option contract is one where you have a kind of pen scenario of an option either execute a contract or either to cancel a contract in the particular scenario. So this is the foremost important point, and most of the trading happens with an options contract only. So in basically options contracts are two. One is in call option, the another one is in put option. And call option is one where being a kind of an option holder, getting a right, not an obligation to buy an asset at a specified price on is on or before a specified date. So that is an American style option what I'm trying to discuss here. And put option is one, it is an agreement between two parties, either to sell, that is to sell an asset. It is a right, not an obligation again. So to sell an asset, he has to buy the put option at a specified price, which made it very clear in the terms and condition on or before the specified date. Is something about in put option. The next one is something we call them about in swaps contract. So swap contract is nothing about in swapping of your particular scenario. So that is nothing about an exchanging of your stream of cash flows, either in terms of interest rates or might be in terms of cash flows. So swap can be defined basically as in both or exchange. Basically, swap is also an agreement between two or more parties to exchange a stream of cash flows over a period of time in future. So stream of cash flows is something called about, and take an example again here. Being a made an agreement between an US based company and Indian company. For this you made an import of goods. For this you have to make a payment in dollars. So stream of cash flows is something called about in a common stream of cash flows need to be there. Either both the countries agreement made company agreement made with a kind of an stream of cash flows is something called about in dollars. So made an agreement. So you made an import that you have to make in $1 million. So at the end of the something about a contract period, which is something about, and you have to transfer your $1 million. Something about the dollar price might be anything, might be something about an 85 rupees as of now. Today, if you take an example around something around 83 rupees. So even it is something about shoot up to 90 rupees or 95 rupees, whatever it may be. If you have been benefited with an free cash flows in terms of your common denomination, then you can able to enter into the particular contract. So that is something about it in terms of your stream of cash flows or in terms of your interest rate. So basically, swap contracts are two categories. One is something called about an which is related to the currency swaps, as well as the another one is something called about an interest rate swaps. So interest rate swap is nothing about an which is an entail swapping only the interest related cash flows between the parties at the same currency, which I told you about previously. Same common currency, either in dollar or in rupees. So come to the conclusion with the same currency, they go for exchanging of the cash flows is related to the interest rate swap. that is within exchanging of your interest rate, that is in floating rate or fixed rate, which is something called about, take an example about in LIBOR rate, London Interbank Offer Rate. So LIBOR plus 0.5. If suppose take an example, the LIBOR rate is something called about in 5%. If it is on LIBOR plus 0.5%, then LIBOR rate is on 5%. 5 plus 0.5, then it is on 5.5% you are going to exchange, which is a common currency, either in terms of rupees or in terms of your dollar signs, in terms of some other currency. Common currency should be there. That is exchanging in terms of your interest rates. That is in fixed rate concept or might be in terms of your floating rate concept. So LIBOR rate, which I am discussing about in floating rate concept scenario. Fixed rate is one. If suppose if you have been entering into a contract with a fixed rate of an 8%, so you have to execute the contract with an 8%. Either the market may extend to even 10%, or either the market will be might be declined to something about in 4% or 3%, depends on the different scenario. So which is a scenario which is applicable, mutual understanding, they get into the contract for the particular scenario. The next is something called about in currency swap. So this entails swapping both the principal and interest between the parties, with the cash flows in one direction being in a different currency that the cash flows in the opposite direction. So currency from dollar to rupees or might be rupees to dollar, whatever it may be. Whereas in the interest rate, it is a common currency that's supposed to be done. So between the countries, so two exporting companies doing a trading, either exporting or importing. So stream of cash flows which have been transferred, that is an currency swap. So with a common interest rate, the common currency with an interest rate fluctuations, if they do a trading, then it is called about an interest rate swap. So if that is a scenario, probably financial derivatives, which we want to make it very conclusion about the particular thing. So basically, financial derivatives is a kind of security. Now we come to the overview about the summary of the scenario. So financial derivatives is a kind of security whose value is derived by an underlying asset. The underlying asset might be anything, might be a commodity, might be a bonds, might be a Sensex, might be a share price, might be anyone. Either any, either table or anything might be there. So based on the underlying asset only, the value might be determined. So basically, derivatives is not an independent one; it is an dependent one. So we covered something called about in classifications of four categories. So forward contract, future contract. Third one is an options contract, the most dominant and important one. Fourth one is something about in swaps contract. So an investor who are ready to take risk, then they can enter into the capital market, want to protect their money at the same time, want to have some decent returns, something about safeguarding scenario, then it is not advisable to enter into the capital market. For such kind of an investors, better advisable to enter into the derivatives market, where there will be a concept called about an hedging, protecting the risk. Uncertainty to some extent can be covered in a particular scenario. So this is something about in today's class have been discussed. Thank you one and all. Thanks for your patience for listening the presentation. Thank you. Thank you one and all.